See, expected return of a portfolio depends on the expected returns of the security and the portfolio weights. But see the yellow boxes. The expected risk depends on three things. First is risk of individual securities, their weight in the portfolio, and their interactive risk. अब ये एक थर्ड एलिमेंट आ गया, इंटरएक्टिव रिस्क. हाउ डू दीज टू सिक्योरिटी बिहेव व्हेन दे आर टुगेदर. इंटरैक्ट जब ये करती हैं, एक साथ होती हैं, तो इनका क्या बिहेवियर होता है. It depends on that also. So yes, it depends on the risk of the security, that means standard deviation of the security. It depends on the weight. But there's a third element which you need to consider. What is the relation between these two securities? How are these two securities related to each other? That third element is called interactive risk. And there are different measures of interactive risk. Two of them we will be doing. One is called covariance of a security. Covariance of two securities. The covariance would always be of two securities. And second is coefficient of correlation. These two are measures of interactive risk. Return of a portfolio depends only on the weights of each of the security and their return. But risk has a third dimension, which is the interactive risk between two securities. तो रिस्क जो है वो स्टैंडर्ड डेविएशन जो हमने यहाँ पे किया ना, देखिए जस्ट लुक एट दिस. व्हाट वी डिड वाज वेट ऑफ ए इनटू स्टैंडर्ड डेविएशन ऑफ ए प्लस वेट ऑफ बी इनटू स्टैंडर्ड डेविएशन ऑफ बी. दैट मींस वी आर ओनली कंसीडरिंग वेट एंड स्टैंडर्ड डेविएशन. But there is a third element which we needed to consider in this formula. That was how security A and B are related to each other. How do they behave when they are together? Maybe when A goes up, B goes down. Or when A goes up, B also goes up. So there is an element of relation between both of them. Unless I find out that relation, I cannot tell what kind of risk the portfolio will have. So what I said was return depends only on weights and returns, but risk depends not only on the individual risk and individual weights, but also on how they behave when they are together. And that behavior of two securities when they are together is measured by two statistical concepts which are called covariance and coefficient of correlation. Is this making some sense to you? Because without understanding this, you cannot make a portfolio. It might happen that when CGI goes up, DSC goes down. So if that is happening, this middle line would be the line of the portfolio. That means by combining two risky securities, I can create a portfolio whose risk is less than each one of them. That means by combining CGI and DSC, so if I combine CGI and DSC, the minimum risk which is possible is what? If I put 100% money in CGI, what would be the risk? 3.46. If I put 100% money in DSC, 10.58.
Yes.
Can I create a portfolio by combining CGI and DSC whose risk is lesser than 3.46?
No.
No, sir. No, sir.
Yes.
Between.
Yes. If the relationship between them is perfectly opposite to each other. Maybe I am able to create a portfolio whose risk is lesser than 3.46. And that's the beauty of creating a portfolio. See here, when one goes up, other goes down. Right? So a portfolio is created whose risk can be lesser than the individual risk of each of the security. If the relationship is completely opposite to each other, and we'll see how it works. But please remember, that's the reason we create portfolios. We want to reduce risk without reducing the return. Ideally, what should happen? You should have all the return without the risk. That's the ideal world. कि मुझे रिटर्न मिल रही है, रिस्क जीरो है, इससे बढ़िया तो कुछ नहीं हो सकता. But that in real world is not possible, because you will not get securities which are totally opposite to each other. But even if the relationship is somewhat opposite, I can create a portfolio whose risk is lesser than the individual securities put into that.
Sir, any example?
I show it mathematically to you.
Sure.
I show you mathematically that thing. Okay. So suppose I say that the correlation coefficient between CGI and DSC is minus 0.655. That means, what does this mean? What does this mean? This means when CGI goes up by 14%, DSC goes down by 0.655 into 24%. If one is going up, other is going down, because the relationship between them is 0.655. So if CGI goes 14% up, DSC goes down by 14 into 0.655. That would be 9%. तो अगर एक मार्केट में जो CGI है वो 14% बढ़ रहा है, उसी टाइम DSC 9% गिर जाएगा. यही इसका मतलब हुआ कोरिलेशन कोएफिशिएंट अगर इनका -0.655 है.